When you think about the moments that reshape civilizations, your mind probably drifts to the obvious cataclysms woven into American schoolbooks and documentaries, those pivotal inflection points where the architecture of power shifted beneath the feet of millions who never saw it coming. The stock market crash of 1929 brought wealthy bankers plummeting from penthouses to soup lines, wiping out fortunes that had seemed invincible just weeks before the Black Tuesday deluge. The Nixon shock of August 1971 severed the dollar from gold and effectively rewrote the rules of international finance, leaving global leaders scrambling to comprehend a monetary world unmoored from precious metal. The 2008 financial crisis froze credit markets, collapsed housing values, and triggered bailouts measured in trillions, forcing governments to prop up institutions deemed too big to fail. Each of these moments redefined wealth, power, and survival for generations. But what if all three combined into a single converging storm? And what if that storm is already gathering on the horizon, marked 2027? You need to keep watching until the very end to fully understand how the threads connecting these historical earthquakes are tightening around the present moment, and how the mechanisms driving the next collapse might dwarf anything witnessed in living memory. Drop a comment below and tell me where you're watching from, your city and your country, because this story touches every corner of the globe, and understanding your perspective helps build a fuller picture of how this reset will land differently across continents and communities. The term Great Reset entered public discourse in June 2020 when Klaus Schwab, founder of the World Economic Forum, announced an initiative aimed at restructuring global economic and social systems in response to the COVID pandemic. Schwab outlined three core components involving stakeholder capitalism, sustainable recovery using environmental and governance metrics, and harnessing innovations from what he called the Fourth Industrial Revolution. The initiative was launched with Prince Charles and joined by United Nations Secretary-General Antonio Guterres and International Monetary Fund Managing Director Kristalina Georgieva, signaling the backing of major global institutions. While the official narrative emphasized rebuilding fairer systems and greener infrastructure, the timing and scope triggered widespread speculation about deeper motives involving monetary realignment, wealth consolidation, and the acceleration of digital transformation programs projected to represent over $60 trillion in revenue by 2025. Whether you view the Great Reset as a benevolent restructuring or a coordinated power grab depends largely on your position within the existing hierarchy, but the underlying economic pressures driving it forward are undeniable and intensifying with each passing quarter. The United States national debt surpassed $38 trillion in October 2025, a figure that translates to roughly $111,000 of debt per individual American and equals the combined economic output of China, India, Japan, Germany, and the United Kingdom. This milestone arrived just over 2 months after the debt crossed $37 trillion in mid-August, illustrating an acceleration that defies sustainable fiscal logic. The nonpartisan Congressional Budget Office projects that debt could reach 200% of gross domestic product by 2047, driven partly by sweeping tax cuts embedded in recent legislation. Economists from the Penn-Wharton budget model assessed in 2023 that financial markets would not accept United States debt levels surpassing 200% of GDP, establishing a theoretical ceiling beyond which confidence collapses and a sovereign debt crisis becomes inevitable. While debate continues over precisely where that breaking point sits, consensus holds that the current trajectory is unsustainable, and the mathematical endpoint involves either drastic fiscal contraction, currency devaluation, or a structural reset that forces bondholders and creditors to absorb losses. The federal government currently operates with a 6.75 to 1 debt-to-revenue ratio, meaning for every dollar collected in taxes, nearly $7 in obligations hang over the Treasury. This imbalance mirrors the structural dysfunction that preceded previous collapses. But the scale this time dwarfs historical comparisons because the dollar itself serves as the world's reserve currency, amplifying the global ramifications of any American fiscal rupture. The Federal Reserve's balance sheet stood at $6.58 trillion as of November 12, 2025, down from a peak near $9 trillion during the pandemic, but still 3 times the size it held before the 2008 crisis. This contraction reflects the central bank's quantitative tightening program, initiated in June 2022, which has reduced securities holdings by over $2 trillion through controlled runoff of Treasury securities and mortgage-backed securities. The sheer magnitude of assets accumulated through successive rounds of quantitative easing represents an unprecedented monetary experiment with no clear historical parallel, creating vulnerabilities that remain poorly understood, even by the architects who designed them. When Silicon Valley Bank collapsed in March 2023, it marked the 3rd largest bank failure in United States history and the largest since 2008, triggered by a textbook case of asset-liability mismatch and interest rate risk that supervisors failed to address, despite the bank growing from $71 billion to $211 billion in assets between 2019 and 2021. Depositors withdrew $42 billion in a single day, an outflow velocity that exceeded anything witnessed during the Great Depression, and demonstrated how digital banking enables bank runs to unfold at a speed that outpaces regulatory response. The collapse coincided with failures at Silvergate Bank and Signature Bank, exposing systemic fragility beneath the surface stability that officials had assured the public existed. Companies ranging from Roku to Roblox to Etsy found themselves locked out of hundreds of millions in deposits, and over 1,500 climate technology startups lost access to credit lines precisely when scaling up to meet Inflation Reduction Act demand. The crisis required emergency interventions that effectively guaranteed deposits beyond insured limits, setting a precedent that reinforces moral hazard while confirming that the system remains as vulnerable to cascading failures as it was in 2008. The parallels between 2023 and 1929 extend beyond bank failures to the underlying economic distortions that precede systemic collapse. In both eras, extended periods of easy credit inflated asset valuations far beyond sustainable levels, creating wealth effects that appeared permanent until confidence fractured. The 1929 crash initiated the worst economic contraction in modern history, with bank runs leading to widespread failures that the Federal Reserve failed to contain through active monetary policy, allowing deflation to spiral into a decade-long depression. The 2008 crisis matched the 1929 shock in initial magnitude, but policymakers applied lessons from the earlier disaster by flooding the system with liquidity, ensuring deposits to prevent bank runs, and bailing out institutions to maintain public confidence in the banking system. These interventions prevented a repeat of the Great Depression's deflationary spiral, but they also created new distortions by backstopping risk, concentrating financial power in fewer institutions, and inflating central bank balance sheets to levels that now constrain policy flexibility. The question facing 2027 is whether authorities retain sufficient ammunition and credibility to repeat the rescue playbook when debt levels have exploded, political will for bailouts has eroded, and alternative financial systems are emerging to challenge dollar hegemony. The 1971 Nixon shock severed the dollar's convertibility to gold, ending the Bretton Woods system that had anchored international monetary stability since 1944. President Richard Nixon's decision came after sustained speculative attacks against the dollar, driven by Germany's unwillingness to continue accepting dollar inflows that threatened domestic inflation, and by growing doubts about American willingness to subordinate domestic priorities to maintaining a fixed parity. The Bretton Woods system had fixed the dollar to gold at $35 per ounce, while other currencies maintained fixed but adjustable rates against the dollar, creating a two-tier arrangement that became increasingly fragile as United States deficits intensified. By the spring of 1971, Germany stopped intervening and allowed the Deutsche Mark to appreciate, setting off expectations of further currency realignments that accelerated capital flight from dollars into marks and yen. When a further devaluation of the dollar against gold failed to stem outflows in early 1973, Germany and European partners floated their currencies, and the Bretton Woods fixed exchange rate system finally expired. The collapse represented a fundamental reset of the global monetary order, transitioning from commodity-backed currency to pure fiat money backed solely by government decree and economic confidence. This shift unleashed decades of dollar dominance unmoored from physical constraints, but it also created conditions for the debt accumulation and monetary expansion that now threaten a different kind of reckoning. Currency collapses throughout history reveal consistent patterns involving gradual decline over years, an acceleration phase lasting months, and final collapse unfolding over weeks or days. The German Weimar Republic's hyperinflation reached 29,500% by October 1923, destroying the middle class and destabilizing society as prices doubled every few days. Zimbabwe's hyperinflation peaked at 231 million% annually in 2008, forcing abandonment of the currency entirely. Venezuela's bolivar lost over 99% of its value between 2013 and 2020, demonstrating that currency collapse remains a contemporary phenomenon despite modern economic tools and supposed safeguards. These examples share common elements, including government interventions, like price controls, and capital restrictions that accelerate rather than prevent decline, and inflection points where public perception shifts suddenly despite fundamentals having deteriorated long before. Wealth transfers rapidly from one asset class to another as individuals and institutions scramble for protection from devaluation, concentrating assets in the hands of those positioned to anticipate and exploit the transition. The Bretton Woods collapse in 1971 offers a recent example of global monetary reset, with transition timeframes spanning several years, as initial instability gradually gave way to new arrangements. The critical difference facing 2027 is that no commodity anchor exists to stabilize a new system, and the scale of debt and financial claims exceeds global productive capacity by orders of magnitude, creating a mathematical impossibility that must resolve through default, inflation, or forced restructuring. The BRICS nations comprising Brazil, Russia, India, China, and South Africa are actively working to reduce dollar dependence and promote a multipolar financial system that enhances economic autonomy for emerging economies. While the dollar still accounts for 59% of global foreign exchange reserves, as of 2024, concrete steps toward de-dollarization are accelerating across multiple fronts. China and Russia now conduct most bilateral trade in yuan and rubles, bypassing the dollar entirely, while Brazil and China signed a yuan-real trade settlement agreement in 2023. India has begun purchasing Russian oil in rupees, and Saudi Arabia's addition to BRICS in 2023 positions the group to challenge the petrodollar system that has channeled energy transactions through American currency since the 1970s. At the 2025 BRICS summit, Russian President Vladimir Putin appeared holding what seemed a prototype BRICS banknote, though he backed away from aggressive de-dollarization rhetoric and emphasized the goal was deterring weaponization of the dollar rather than abandoning it completely. Brazilian officials stated no significant steps toward a unified BRICS currency are planned, but cross-border payment systems utilizing blockchain technology remain a major focus, offering infrastructure to conduct trade outside dollar-dominated channels like SWIFT. President Donald Trump explicitly threatened 100% tariffs on BRICS exports to the United States if any attempt to bypass the dollar proceeds, demonstrating American awareness that reserve currency status underpins geopolitical power and that losing it would fundamentally alter the global balance. The timeline for meaningful dollar displacement remains uncertain and faces enormous obstacles, including BRICS internal disagreements, the dollar's unmatched liquidity, and network effects that entrench existing systems. But the direction of travel is clear, and the strategic imperative driving it grows stronger with each round of sanctions and monetary manipulation that weaponizes reserve status. The World Bank stated in its Global Economic Prospects report that by 2027, global GDP growth is expected to average just 2.5% in the 2020s, the slowest pace of any decade since the 1960s, concluding that the time has come for a reset. This assessment from a core institution of the international financial architecture signals recognition that structural problems require structural solutions, not merely incremental policy adjustments. Economic forecasts for the United States show growth slowing to 2% in 2024, before a modest rebound approaching 3% in the final years of the forecast period. But these projections assume soft landing scenarios involving limited tariffs and extended tax cuts. Alternative scenarios, including trade wars with 60% tariffs on China and 10% blanket tariffs on other nations, would bring average tariff levels to heights last seen in the 1930s, potentially triggering severe disruption in international trade and recession. The Office for Budget Responsibility forecasts that United Kingdom growth will slow to 1.8% in 2027 and 1.7% in 2028, reflecting similar global headwinds. These projections carry substantial uncertainty that increases the further into the future they extend, but the consistent theme across institutions involves slowing growth, mounting debt burdens, and narrowing policy options for addressing shocks. When the next crisis arrives, whether triggered by debt markets, banking failures, geopolitical conflicts, or some combination, authorities will face constraints that didn't exist in 2008, including political resistance to bailouts, central bank balance sheets already bloated from previous interventions, and alternative power centers actively working to undermine dollar-based solutions. The convergence of these forces creates conditions unlike any previous crisis because elements that were separate in 1929, 1971, and 2008 are now simultaneous. The debt overhang exceeds Great Depression levels relative to GDP. The monetary system faces credibility challenges echoing 1971, but without a gold anchor to reset against. And financial fragility mirrors 2008, but with larger institutions, faster transmission speeds, and less policy space to maneuver. Digital transformation programs accelerated by the official Great Reset narrative are creating infrastructure for central bank digital currencies and programmable money that could enable unprecedented control over transactions, savings, and economic behavior. Whether 2027 is the specific trigger year remains unpredictable, but the mathematical and structural pressures building within the system guarantee resolution within a time frame measured in years rather than decades. Understanding how these pieces fit together and what historical patterns reveal about how resets unfold separates those who get blindsided from those who position themselves to navigate the transition, and the window for preparation narrows with each trillion added to debt totals and each incremental loss of confidence in institutions that have promised stability while engineering fragility.